So, Steve, we're going to start with an actual illustration with one of our top whole life insurance companies. And the way this is funded is on a 35-year-old female. What she's doing is putting in $35,000 a year plus a $40,000 lump sum. What we see here in year one, contract premium then of $75,000 and $35,000 thereafter. Now, here's what's amazing. This is a high cash value whole life policy with a paid up additions rider. In a traditional whole life policy, there would be $0 of cash value here. But because this is properly designed, her total net cash value in year one is over $71,000. So just for the fun of it, let's take her $71,768 in first year cash value, divide it by the $75,000 she's put in. See, that's over 95% of her premium going to cash, which is remarkable. Traditional whole life policies don't function that way.
Right. So Barry, in your experience, is this pretty common that you can accomplish this with a high cash value policy? Is this pretty standard stuff?
This is pretty standard if the policy is designed correctly. And unfortunately, most life insurance agents out there are just selling traditional whole life. What we do at Insurance and Estates is turbocharge cash value for clients, minimize death benefit, maximize cash.
Okay, and we've touched on that recently, base versus, again, paid up additions or the cash component of the policy.
Exactly.
Right.
Every year that she's putting in that $35,000, notice this cash value is always growing. There's a guaranteed rate of return and she's earning a dividend. What I find so remarkable here, Steve, is in year three, when we look at her cumulative premium, she's put in $145,000. Her cash value is pretty close to that. So I would say that her break-even point is around the third year. From that point on, every year thereafter, her policy is growing by more than she put in. It's always increasing greater than the $35,000, and it's growing by more than the year prior because this is a true compound interest policy. Every year there's compounding that's taking place. She's always making more money from one year to the next.
Barry, when people are looking at this, they're getting into it, you've got guaranteed return and then you have dividends, correct? And that's driving that growth.
That's exactly right. In a whole life policy, you never lose money. There are no increasing insurance costs. We've talked often about IUL or other type of universal life products that do have increasing costs where you could either go stagnant or lose money, or your premiums can go up because of those costs. Whole life has a fixed cost, so you never have to worry about losing money, but you can always count on a guaranteed growth rate every year.
Yep, that's important.
So we're going to make an assumption that she now wants to take a policy loan in year two. And in year two, she's sitting on $107,000 of cash value. She wants to take a $100,000 loan. So let's look at the numbers. We'll come back to our compound growth curve. Her total cash value in the second year is $107,000 CV. She's going to take a policy loan for $100,000. And Steve, this is what's so amazing. Even though the insurance company gives her a loan, they don't physically remove the $100,000 from her cash value. So that total $107,000 is still compounding. She's making money, interest and dividends on the total of the $107,000, but she has the $100,000 that she can also go put to work, whether that's in her own business, another investment, a real estate deal. So she's now making money in two places, and the full $100,000 is still earning interest and dividends inside the policy.
Yeah, and that's an important point. People, need to know the power of the fact that the money keeps working, keeps moving. You have that velocity of money working there because you didn't slow it down by taking it all out. It's still working, right? And it's a big part of the strategy.
It's huge. The velocity of money, I'm glad that you brought that up, that your dollars are doing more than one thing at the same time. What happens is the insurance company really does give her a loan for the $100,000, but that $100,000 is not physically removed from the 107. So let's look at the math. I'm going to pull up a funding calculator.
Well, and Barry, this is why we put cash into these policies, right? Because it's a better place to put it than to try to keep it, somewhere else. Take your pick.
That's right. And if the policy is earning around a 5% net tax-free rate of return, it's better than what most people are getting in the bank or in a CD. And because it's growing guaranteed and tax-free, that 5% net tax-free return, it feels more like a 7, 8, 9, 10% rate of return if you were in the market. Because if you're in the market with your 401k or IRA, you have to factor and minus out volatility, fees, taxes to net down to 5%. So if you can sleep well at night, have this peace of mind, earning a 5% tax-free rate of return, that's remarkable in a life insurance policy.
Yeah, peace of mind is one of the things that drew me into this area in the first place, as you know, Barry.
Yeah, as an estate attorney, you're talking to people all the time about legacy and their future and family and asset protection. They want peace of mind.
Yep. And retirement planning.
Yeah, that's a huge topic, Steve. Right? A lot of people out there are crossing their fingers, hoping for a good outcome. But when you're in the market, you have no idea what the outcome is going to be. Here we're talking about guaranteed growth and tax-free use of money. So a lot of peace of mind.
So in this case, she decided, our client decided to take out policy loans fairly early, and this is what's happening when she's deciding to do that.
That's right. And she can take policy loans out really anytime. You can borrow up to about 90 to 95% of total cash value. You can have multiple loans. So if she took out a $50,000 loan, well, she would have room for another $50,000 loan. And it's really up to the client as to how they want to pay those loans back. So let's look at those numbers. We'll get into some actual details with a loan analysis calculator. So we're going to put in the $100,000 loan balance. The interest rate today with most companies is around 5.7%, 120 months. Now, I'm just making this up. This is a 10-year payback on the 100,000. But she can choose if she wants to pay it back in 10 years or 5 years or 30 years. The insurance company doesn't really care. As a matter of fact, Steve, you know this as well. The insurance companies don't even require you to make a payment back. We're going to encourage people to be an honest banker, right? Pay the loans back.
Some people might take policy loans out as a retirement strategy, and maybe that part of their plan is to not pay it back. So it's all depending on what somebody wants to do, correct?
Yes. And in retirement, it is a different strategy where we tell people they don't have to pay the loans back because those will come off of their death benefit when they pass away. But during their younger years or working years or years they have income, we want to encourage people, be an honest banker, pay the loans back. Therefore, you'll have more money in the future to take more loans down the road.
This is good for our real estate investors or people that want to leverage this for higher risk investments.
Steve, I'm so glad you brought up real estate investors. I'm a real estate investor myself. I use my cash value as down payments on real estate to go buy more real estate. So I cash flow on the real estate. I'm still making money in the policy. So if you're a real estate investor out there listening, you will actually enhance your real estate portfolio by having a high cash value whole life policy because you're double dipping. That velocity of money is ever present.
So it changes your numbers, it changes your ROI if you're sophisticated about it, correct?
That's correct. Yeah. And Steve, this is what the wealthy do. They leverage their assets. So exactly what you're talking about. Policy loans for real estate, policy loans for your business, policy loans for other types of investments. The wealthy leverage assets. We want to teach people how to do the same. Her 10-year monthly payment back to this loan is the $1,095. And every month that she makes a payment back, the balance of the loan is being reduced. Well, what that means is she's being charged less interest over time. We call this principal reduction. And I want to paint a picture of what's actually happening here. So we're going to go back to the whiteboard, and we're going to show that this straight line represents the dollar amount of zero. So she took a loan. She's going to pay it back over time. And this is a loan rate we set of 5.7%. She's paying less interest over time because of principal reduction. Her total interest cost over that 10-year time frame is this number at the bottom, $31,424. So we're going to write that down. 31,000.
Is that 5.7 over 10 years, Barry? Is that how you came to that?
That's correct. That's correct.
Okay.
And Steve, we want to be really clear here. That 5.7% is going back to the insurance company. It is a loan that they gave to her, but she's still making money in the policy, which we're going to get to in a minute. But the $31,424, that is interest that she would have paid the insurance company.
Yeah, that's one of the dispelling one of the misnomers or misunderstandings about this area, right, Barry?
If you're reading out there on the internet that all the interest goes back to you, That is a
Yeah.
misleading, incorrect statement. The interest goes back to the insurance company.
Right. And if you're hearing that, then maybe you want to keep looking for the right expert. Little plug there, really.
That's right. This 5.7% is a variable rate. Most companies have a variable rate. Today, 5.7% is average across the top companies that we use. Could go up, could go down. It is a variable rate. But here's the benefit, as you mentioned. As interest rates go up or down, you can also see a change in the dividend that you're earning. So if interest rates go up, chances are you're going to see higher dividends that would offset the higher interest charge.
Gotcha.
By the way, there is no fee to take a loan. They simply charge you the interest.
The other thing you already brought up, Barry, which I think is exciting, is that when you pay it back, then that basically frees up that capital again. So whatever amount is paid back is once again available for another policy loan.
That's right. And these loans, Steve, are so much easier to get than a bank loan. Number one, there's no credit check. There's no application, and they're not questioning you. What do you need the money for? They don't care because your cash value and death benefit are acting as collateral.
And I love talking to business owners, chiropractors, investors. This is so ideal for these groups that are going to need working capital down the road, have another asset on the balance sheet, a top tier asset. So those are all exciting aspects of this, I think. Barry.
Yeah, love it. Now, to be fair, we're going to show the 5% earnings rate. And you say, well, wait a sec. I'm paying 5.7%. I'm earning 5. So there's this cost of 0.7% to take the loan. And yeah, that could be true, but check this out. Remember, your $100,000 was still compounding inside the policy. The way we're going to view this is through a future value calculator to see the difference. And we'll do a side-by-side comparison. Steve, here's the future value calculator. We're going to put in the 100,000 loan amount that she took out, earning 5%. And we're going to calculate this over 120 months. So her money over that 10-year time frame grew to 164,701. The difference between the 100 and the 164,701 is $64,701. So let's write that down. 64,701.
That's the amount made from the 100,000 over 10 years.
That's correct, inside the policy, and it was compounding. So now if we look at the difference between what she earned in the policy, 64,701, minus what she paid to the insurance company, Steve, of 31,424, even though she had a policy loan, she came out ahead a positive $33,000. And this is the point we want to emphasize. Money was still being made in the policy. So people will say, gosh, there's interest to take a loan. Yes, but you were still earning interest and dividends on your total cash value. And for her, boom, $33,000 more. And she was able to invest in the business, and she had real estate, and she had an investment along the way.
Interesting. Now, if we were going to do a longer webinar, Barry, you could crunch the numbers on the ROI there on that money. And then I suppose if she parlayed some of that into another investment, you could crunch the numbers on the ROI there, and we could then see how powerful that actually was, correct?
Exactly. And in addition to what you're saying, not only can they make more money on the ROIs that you're talking about, what if she decided to pay the loan back at a rate higher than 5.7%? There's a lot of doctors out there and business owners out there that are leasing equipment. And on the back end, they might be paying 8, 9, 10, 15% interest, and they don't even know it. Well, what if you paid your policy loan back at a higher loan rate? And then we can have that extra interest above the 5.7 going back into your cash value. You're the bank. You're capitalizing on those returns, not a third-party lender.
Yeah, and Barry, when people are working with you on those kinds of decisions, you're helping them decide how much they can put back, correct? So
that's correct. And we've talked about, Steve, not only the power here today of a properly structured whole life policy, but people are now seeing very clearly, if I take policy loans and use my policy, I can create more wealth. So we want to invite people to learn more, watch more webinars, reach out to us, and begin to look at your own numbers.
Well, that's fantastic, Barry. Great